Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And that's it for me, and I'll take the questions after Steve's done sharing. Thanks, Steve. All yours.
Thanks, Jack. Very interesting, as always. Can't wait to, I'm getting a lot of questions. I can't wait to relay the questions to you. Let me just go through a couple brief slides about ISEFX options. As Jack said, lots of scenarios out there. A lot of us might agree with Jack. Some of us might disagree with Jack. But there are ways to trade, whether you agree or disagree with Jack's view. And again, a lot also depends on what your time frame is. You know, if you're playing in a couple weeks, couple months, you know, all the way out to maybe 10 or 12 months, you might even have a different view in a different time frame. So let me just take a step back and explain about the ISEFX options. They are dollar-based, which means the dollar is the numerator in all of the pairs. So it is what $1 is worth in another currency's value. So whether you're going to Canada or Europe, Japan, whatever, that's really the way the ISE convention was set up. And the reason for that is that it was what is $1 worth in another currency, so that we could look at it from a dollar-based situation. So if it would be standard for all 6 pairs. I mean, actually, we have 9 pairs now. Dollar is the numerator, so you might be familiar with dollar yen. You might be familiar with the dollar Swiss franc, dollar Canadian, but you might not be familiar with dollar euro, dollar pound, dollar Australian. Remember, it's the dollar as the base currency. So, as Jack was saying, if you believed that the dollar would rally, you might look at calls or call spreads. If you think we're going to continue to go through what we went through the last 5 months, well, the trend has been dollar down. So if you think in those terms, dollar down, that's a put. Dollar up, it's a call. So it's that simple. Let me just explain how easy it is to look at this. For those of you that are familiar with the spot market, you just turn it into the dollar-based valuation. So dollar Australian, dollar Canadian, dollar Swiss franc, dollar British pound, dollar euro. We multiply all those values by 100. Dollar yen, we leave it as it is. So you see that becomes a $118 number, 106, 106 again for the Swiss franc, $59 number for the pound, $95 number, and euro is about a $69 number in that ISE value. How do you come to that? It's just the inverse in the other 3, the Australian, the British pound, and the euro. Taking the inverse of 139, you get 71. So if we're trading at 142, it's roughly 69. So you can do that very, very easily. Looking at the charts over a longer term, we see dollar rally all last year. If you go to the left side of your pane, whether that's AUX, that's dollar Australian, dollar British pound. In fact, you're going to see in 5 of the 6 pairs of that same exact situation. The only one that's a little bit different, and Jack alluded to this, is the dollar yen, because the yen has now been actually, some of the Asian countries, as Jack was saying, have actually been parking some money in the yen during periods of what they view as to be a very risky time frame. So last August, September, October, November, and I'll show you that. You'll see it in U.S. dollar terms, dollar very, very weak. But if you take, and I'll actually take my pencil here, dollar very, very strong. Let me pull this. Dollar very, very strong. November, in fact, it actually made another new high there in March. As the U.S. equity markets, that was Australian. A little bit different here, but not that much different. In fact, pound actually weakened all the way through February, and then the pound has strengthened. So you see that there. You see that downtrend, that is dollar-based. Dollar Canadian actually peaked for the dollar, U.S. dollar, at almost 130-ish, or maybe even a little bit above that in March, and now we've seen an approach of back to a par or 100. So we'll see how that plays out. In fact, of course, you can trade options on that. If you believe the dollar is going to go, U.S. dollar is going to go weaker, you can buy 100 puts or even lower. Same thing here in the euro, as we're trading now around 69. Dollar Swiss franc around 106. And this is the one that's not acting the same. Dollar yen. Remember, as the economies weaken throughout the world, investors were buying more and more yen, hiding in the yen. So you see the dollar was actually very, very weak. And now the dollar has stabilized against the yen, although we'll see what happens there. As Jack said, the next risk aversion bid, what will happen? Some of you may think that the dollar may actually weaken even further against the yen. Of course, some of you may think the dollar is going to strengthen. So that's what makes the options market so great. So let's take a look at dollar Canadian. So if you're looking at the crude markets, commodity markets, and you think that green shoots will continue, well, ever since this green shoots idea was, I guess, popularly expressed in the spring, what's happened? Well, the U.S. dollar has gone straight down. So if you believe that that will continue, puts might make sense. If you want to take a contrarian view, calls might make sense. So looking at a couple prices as of the other day, you'll see December calls, and this is interesting. The 115 calls were priced at $1.40. 115 calls, I mean, look at this. We can get back to a moving average at 120 here. I don't know what that moving average is, maybe 50, 60 days. You'll notice maybe it's 100 days, but that is at 120, and you can buy the DEC 115 call at $1.40 if you believe the U.S. dollar was going to rally. So U.S. dollar rally, you'd be looking for call purchase or maybe spreads. If you thought the dollar was going to sell off even further, you'd be looking at put options. So you could create break-evens at expiration based on buying a single call. You just add the strike price to the call premium, and you'll see that obviously the break-evens move higher as you get more leverage. So buying the 115 call, and then, of course, including the premium, you'd need the dollar to get to 116.40 at expiration. Conversely, if you were bearish, you could buy the 100 put, roughly, this is the other day, Monday's prices, at $1.25, and you dollar to get below parity, down to 98.75. Those of you who are following it when crude was trading at 140 know that Canadian went to a significant premium, and that could possibly happen again. And if you're looking at that scenario, you'd be probably looking at puts. Dollar Aussie, again, commodities, as Jack was talking about, China can't pull a lot of these commodities fast enough out of the ground, and Australia is doing a lot of that. So if you believed in that sort of scenario, you'd be looking at put options. Granted, we're down from 160 to 118. Can we go to parity? Some are saying yes. That, of course, would mean the commodities would continue to rally. So you have to decide if you believe in that, puts would make sense. That would be the green shoots idea. If you didn't take that viewpoint, you might be buying call options. So taking a look at that, you see the break-evens of the 5-month call, different strike prices. Of course, your break-even points are going to move up as you gain more and more leverage. That should be intuitive. And your break-evens will move down as you move down in the puts. So puts are going to give you that bearish view on the U.S. dollar. Calls are going to give you the bullish view on the U.S. dollar. Euro, again, the Euro made a new high as of the other day, at least a 2009 high. And it's sort of stabilizing at the level, right around that level, 69 or so. You can do the same exact math. If you think that the U.S. is going to emerge first, ahead of Europe, you might be buying any of these calls, depending on how bullish you were.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.